So a question that often comes up is, can my parents sell me their house below market value? What are the tax implications of selling a house below market value? Well, let's take a look. So when you're selling a house to a family member below market value, first you have to ask, okay, what is market value? So market value can be really subjective based on the condition of the house, what the market's doing in general, what's happening in that area, what's next door. All those things will affect market value. But when we're talking about tax implications of transfer tax and capital gains and all that kind of stuff, if you're selling far below what's normal for the area and it gets flagged, they will take the assessed value and they'll compare that to the sale price. So let's go over some pros, cons, and traps and things to watch out for and how to avoid the landmines when you're selling a house to a family member below market value. So first and foremost, there is a gift tax. If it's over $15,000 in a year or $30,000 if you're a married couple, there is a tax on that gift you're giving to a family member. So you're either going to have to pay that now or later down the line, your executor or administrator, if you don't leave a will, is going to have to take it off of your lifetime estate tax exemption, which right now is $11 million, a little over $11 million. That's going to sunset in 2026, and they're kind of expecting it to be somewhere between $5 and maybe a little over $6 million would be the exemption for estate tax. Estate taxes are federal. Inheritance taxes are local. That's for Pennsylvania and New Jersey. The second little caveat is capital gains and depreciation. So in an investment property, you depreciate that property on your taxes. It kind of lessens your tax burden. So if the property in question is an investment property or a property that you've held in an estate for a longer period of time and becomes considered an investment property, you could have capital gains tax implications. In order to be not considered an investment, it would need to be a principal residence. Principal residence is defined as somebody lived there, the owner lived there 2 of the last 5 years. They're going to judge that, or they're going to verify that based on the address you used or the owner used to file their 1040 federal income taxes. So if you file your taxes from 123 Main Street but want to claim 456 Broadway is your principal residence, they're going to flag that and somebody's going to wind up paying capital gains on it. They're going to consider it an investment. Also, it's a principal resident you did not gain from the sale of a 1031 exchange. Talk to an accountant or attorney for the specifics on that, because everybody's situation is a little bit different. I don't want to give you bad advice. Just remember, you can't take a deduction on the loss you agreed to take by selling the house to a family or friend below market value. PA Realty transfer tax. In New Jersey, the seller pays all the transfer tax, and that tax rate is based on whether they're staying in Jersey when they move or leaving Jersey when they move. Back to Pennsylvania, there's 2% transfer tax charged by the state of Pennsylvania when one person buys the house from another. Whether it's an investment property or whatever, it doesn't really matter. It's normally split between the buyer and the seller, unless the buyer and the seller agree to something otherwise. So if the state thinks that they haven't received their fair share, they're going to take 107% of the assessed value. So if your assessment is based on $600,000 and you sell the house for $400,000, they're going to take 107% of that $600,000, figure that's market value, and send the buyer a bill, basically. This is according to title companies that are responsible for holding back the transfer tax and sending them to the state. This is the rule that they follow also. And the reason they go after the buyer for that is normally because the buyer still has the house, the seller doesn't. Plenty of times I've written letters for people to establish market value was less than assessed value, especially in an estate sale. Now keep in mind that Philadelphia has its own transfer tax. Philadelphia charges above the 2%. In fact, they charge their own 2% and then a little more. I think it's around 2.25% for, if you're doing an estimate, that's about what it is. And again, split between the buyer and the seller. So if Philadelphia thinks that they're being shorted, they're not going to likely forgive that and just don't worry about it. Okay. So now I'm going to give you 6 good workarounds and exemptions if you do want to sell your house for less than market value to a family member. These will help you out. So number 1, PA Realty transfer tax exemption. A lineal ascendant or descendant, think grandmother, grandfather, grandson, great-grandson, great-granddaughter, are not subject to PA transfer tax, or Philadelphia transfer tax for that matter. Even a sibling spouse is included in the PA Realty transfer tax exemption unless they remarry, in case they're a widow or widower. Now, giving the house to a lineal descendant and their boyfriend or girlfriend or buddy, that becomes half transfer taxable because the transfer tax is not waived to a friend. Whether it's a friend of yours or a friend of the person you're giving it to, it doesn't matter. They have to be a family member. Number 2, a quitclaim deed, often called a dollar deed. The person buying it, if there are any fees needed to be paid whatsoever, can then take out a HELOC, home equity line of credit. A lot of banks do them, a lot of banks don't. It's a line, just like a credit card that sits on the house. You can borrow against it if you need it in the future. It's not a bad idea to have on your house if you can find one with no annual fees and a good percentage rate. Number 3, an FHA or conventional loan will allow something called a gift of equity. That's where the seller does not have to just take money out of their bank account to give the buyer seller assistance. It also allows the seller to exceed the allowable amounts of seller assistance. FHA, for example, is capped at 6% of the sale price, is all the seller can give to the buyer to help them purchase the house. A gift of equity given to a lineal heir, again, a lineal ascendant or descendant, allows the seller and buyer to exceed that number and give any amount necessary within certain parameters and percentages. A good mortgage broker or lender will be able to help you with that, and a decent realtor will even know how to structure something like that to help you facilitate that. Last one we did, the buyer got in for around, I think it was $1,300, maybe even $1,200. And that was only because he laid out a couple things. He didn't really want to get back because his mother was a seller. But he said, I don't worry about it. Just, take what's owed now and just consider the first $1,200 a wash. Could have got him in for nothing. So that's how good they are. And it will give the seller some money if they want to, if they don't want to just give the entire house. Number 4, the $15,000 or $30,000 for a married couple annual gift exclusion will allow you to gift $15,000 or $30,000 if you're a married couple of equity to the buyer, your lineal ascendant or descendant, every year until you've absorbed the amount of the gift that you want to give. Now that's something you definitely want to have structured by a good attorney or a very good accountant who understands how that would work. Number 5, seller financing. Many an investment deal is structured using seller financing, either in a first position or a second position. It's an actual seller's mortgage that gets put on the house. You set up the terms you want as a seller and a buyer, whatever interest rate you want, or whatever terms you want. You can even use that to coincide with the gift of equity for the $15,000 or $30,000 that's excluded every year. Just keep in mind that debt forgiveness is often still considered a gift if it's between family members. Number 6, a good old-fashioned trust. Set up properly, a trust is one of the best legal instruments ever invented where real estate is concerned. Again, when set up properly. And when setting up a trust, always talk to a professional, experienced, licensed attorney or accountant familiar with setting up trusts. It can really be a wonderful thing and shield you, the buyer, the seller, from a lot of potential issues that could come up in the future. And up here in the Bensalem, Bucks County area, we have a lot of good ones. Even down the shore, we have quite a few good ones. So reach out if you need a recommendation or an introduction. Don't want to pay that hefty commission to a realtor? I don't blame you. Check out my video on selling a house by yourself. It's a lot easier than you think. It's right here. Hey, thanks for watching, and please like and subscribe.